yourself and how we're going to help these amazing people here. I'm just going to adjust my camera in the meanwhile.
Hi guys, so I'm Francisco. I'm one of Remo the Realtor's buyer's agent. So again, thank you so much for joining us this morning. This is definitely the best place to start. You get to know everything in regards to learning about the home buying process from beginning to end. We'll be here guiding you from here all the way through escrow, through the process, through the paperwork, through the forms, through the inspections, all the way to the point where we hand you guys the keys at the very end. So again, thank you so much for joining us, and hope you guys enjoy it.
And can you hear me? Yeah. My name is Rebecca. I'm another buyer specialist on Remo's team. Just excited to be here and be able to help guide people through this process. I know the first step is you have no idea what to expect and what's going to happen. And I know this has so much information in this workshop. So we're happy to be here helping.
And then Kathy.
Hi guys, my name is Kathy. I'm part of Remo's team as well. I'm more on the operations side, making sure we're providing that 5-star service from beginning to, which is right now, all the way to forever, if you guys are okay with that, which I hope you are. So I'm excited you guys are here. You probably got my voicemails and reminders and all of that, so I'm glad you guys made it. Welcome.
And I you know, Kathy normally says the forever part in our conversation. I'll give you an example of what forever is. Well, forever has been, for some past clients that are not tech savvy, we help them fill out the PPP, some government program to help get some money. Also registered some clients to get COVID tested. So our services are obviously just real estate, but we've definitely have stepped in when people needed a helping hand for other things, even after the fact. So thank you, Kathy. And then I see Alina just jumped on. So. Do you want to introduce yourself, Alina?
Of course. Good morning. My name is Alina. I'm one of the buyer's agents as well with Remo. So thank you guys for joining us. I'm excited for you guys to learn a lot of cool nuggets that we'll go ahead and discuss, and also tailor to how the market is right now, because it is pretty unique. So yeah, I'm excited, and thank you guys for joining us. And if you guys have any questions, we're here to help.
Yeah, so today's definitely an interactive workshop. It is not a, watch us or hear us and watch us speak about what we think. We want to make sure this is really hits home for you guys. So we want to ask you a couple questions just to make sure we tailor it in that fashion. So the first question that we'd like you to answer, and the easiest way to do it is through the chat. So on the bottom there, Kathy from our team, she'll be managing the chat. The first question is, how did you hear about us? And then what area are you most interested in? We normally share stories about inspections, and if we want to keep them as relative as possible. So in the chat, you can say how you heard about us, and also what area are you most interested in. That would be great. There'll be a few more questions, but that'll get us kind of going. And then I guess one other question that's really important to us with that kind of sentiment in mind is how, what question would you like answered today? Today would be a successful workshop if I get this question answered, or this is why I'm here. And if you want to put that in there, we'd love to make sure that you walk away here with some value, specific really to you, because that's what you came for. So, so with that, let's get started. And you can still keep putting stuff into the chat. So the first kind of slide or what we want to really talk about is why home ownership, right? Why not stay in your current situation, whether you're renting, whether you're staying with family, whether you're renting with family, or any combination of that? Why not stay in that current situation? Like, what gets you to say, hey, you know what, I'm gonna sit in front of my computer, my phone for the next hour, or next 8 hours, and listen about this home buying stuff? Why is it important to you? And if you want to share it in the chat, that'll be great as well. We'll share some of what our past clients have shared, and also us as well. So the first is home ownership offers that personal and economic security. Really important, and obviously right now being able to be, quarantine ends up happening, then you can have a place to kind of call home. You don't have, anyone, knocking on your door in a sense, because it's yours. Economic security, it's a really big one. And we like to call home ownership as forced savings, meaning that as long as you're making your monthly payment every single month, it's forcing you to put aside some money, right? And that money is in the form of equity, right? Because we'll talk about that in a few more bullet points. So it's forced saving, which is something that's really important. Another neat statistic is by the time someone retires or at the retirement age, right? Someone that's a homeowner and someone that's a renter, a homeowner's net worth is typically 35 times that of a renter. So sometimes it might be difficult and you might say, well, that payment is a little high. You know, I see that, but imagine it just, some of that is going to your savings account, right? And I think that's something that's really important, because the next slide or the next point that we talk about is the control over your living situation. And so for most people, housing is the most expensive thing that they're going to have throughout their life, right? I see some of you have mentioned Eva. I think Eva had mentioned or had said in her workshop that housing is about 35% of the budget. So no matter what, you know, housing is always going to be the biggest chunk of our budget. And so the goal is you want to fix that number as much as possible, right? If you're renting, over time, the rents will tend to go up, you know, and today's kind of a rare thing. We don't have workshops. I guess we don't pay attention to them. But as I was starting the workshop, I looked at the date. Today's the first of the month, right? So rent is due, right? And so every single month, the rent is going to be due, and most likely year over year over year, it's going to go up. And so even though your income will go up, your most expensive item on your budget is also going up. Or if you get into a 30-year fixed mortgage, that relatively stays the same for the duration of your home ownership within that house. So something that's really important. The other thing is more control or not having a landlord. Obviously, that's something that could be important. You know, me and Eva and our family, we like to entertain, and obviously this time it's a lot harder, but generally speaking, we like having people over, right? And if you're in an apartment and you have more than 5 people over, especially if you have some neighbors underneath or on top of you, it just doesn't last long, right? And so having, again, control over that and not having a landlord. Next is you build equity. So you build equity 2 ways, right? So when you purchase a property, and this is kind of your benchmark where you pay what you paid for it, right? Over time, what you owe on the home as you make payments, that amount of what you owe drops, right? So that gap widens of what it's worth and what you owe on it, right? And as you keep making more and more payment, that gap widens. Well, that's one way. The other way that most people have experienced over the last maybe 9 or 10 years is market appreciation. So what you paid for, and now the ceiling, right, of what it's worth also goes up. So again, your ceiling is going up because the value of the home is going up, and also you're paying down the mortgage. So that gap widens, and that's how you build equity. And we reference the 30 to 5 times more is because by the time of retirement, most people are, inching towards maybe paying the house off, or closer to that point than in the start of their 30 year. And obviously that equity gap is a big one if you paid off your house. Next is a big tax deduction. Now, without getting too much into taxes in everyone's situation, an easy example is, let's imagine 2 people are purchasing, their file taxes together, they make 100,000 of income, right? And so if you make 100,000 of income, you pay taxes typically on $100,000 worth of income, right? Unless you have deductions. So one of those large deductions is a home, right? So if you own a home, you have your property taxes and your interest that are deductions. So whatever you pay in that year for your property taxes and interest are actual deductions. So in that same example of 100,000, and if you had $20,000 worth of property taxes and interest, which is pretty common, now your taxable income is 80,000. No longer are you paying taxes on 100,000. So what does that mean for most people? It means that it's an additional, $3,000 to $6,000 more that they would receive in the return that they own a home that they wouldn't have if they were renters. So the tax benefit is a pretty substantial one. Again, it's one of the larger deductions that's available when you're filing taxes. All right, and then obviously the American Dream. Let me read some of this. So Eva, temporary Facebook. Okay, Kathy, next slide. Sorry, enjoying the coffee in the morning. All right, as Eva would say, my cafecito at home. Um, for most people, the first step is typically applying for a mortgage, right? Unless you have cash or you have a rich uncle, is what we refer to it. Most people are going to need some sort of financing in order to purchase a home. And you know, in our world, it's called a mortgage, which is just a loan collateralized by real estate, right? So there's three steps to kind of qualifying for a mortgage, right? The first is obviously you meet with someone that's able to help you. So it's typically a loan officer or a mortgage banker, or we call them, reference them as a lender partner. And so they're going to look at three things to make sure that you are able to obtain financing, right? Sufficient income, enough assets, and acceptable credit history. And we'll go in more detail in each of those. So the first is sufficient income. And this probably has never been more important during this time than it's probably has ever been. And the reason why is when mortgage companies lend out money, their hope is that they receive your monthly payment every single month, right? And so someone that doesn't have a job or doesn't have the capacity of paying every single month, obviously is more likely to default and not pay their bill, right, or not pay their mortgage. And so the banks right now, with everything going on with COVID, are even more and more tougher on this part of the qualifying than they probably have ever had. So in the chat, if you can just share with me, are you a W-2 employee, meaning you're employed by someone or a company, or are you a 1099, or are you self-employed, or do you have a business? Because again, I want to make sure the examples are relevant. So W-2, meaning you're employed, or are you self-employed or have a business, which is 1099. All right, so regarding W-2 employment, so I see a couple of them already answering as that. So W-2 employment is good. It's the more conservative way because it's less risk for the bank, because obviously they know that they're not dependent on business income, because you're doing your job and you kind of get paid for. So what's important about that is making sure that you're going to have a job. So one of the things that's happening during this time is, and it used to happen in the past, but not as frequent, which is called a verification of employment, right? So your lender will send a notice to your employer and say, I want to verify, you know, John Doe's employment, right? And so in this questionnaire that needs to come back, it says, how much are you making? And it obviously has to match what you provided on your pay stubs. What else does it ask? Your likeliness of employment to continue, which is something that's really important. And if there's any recent furloughs or any pay decreases or hour decreases, all these are very important questions, because in the past that, you know, people worked 40 hours a week and we didn't have the uncertainty that we have now with businesses. So if any of those questions come back with not a positive response, then the bank kind of puts the brakes on. So if you're in a job right now that has a chance of potentially furloughing you or reducing your hours, we definitely have to make sure when you meet with the lender that we put that and we have a conversation around that. And it's not to say that you won't qualify. You might not qualify for as much, because in the past, let's say you would qualify for 600,000 with your full income, right? But now if your hours are cut by 4 hours a week or 8 hours a week, now you may be qualified for 500,000. So as long as you're staying at 500,000, then you're fine. Or we make sure that the verification of employment comes back showing 40 full hours. So I know it's really technical and it sounds like it's a lot. It's not that bad. Once you meet with the lender, these are the things that they go over. Now, if you have, I see some self-employed, someone that's self-employed, something that's really important is they look at your net income, right? So if you made $1 million in your business or your self-employed business and you expense $990,000 worth of expenses, because as a business owner, you don't want to pay, you know, significant taxes. So you find any reason to expense things. And so they're going to look at that net number. You made $1 million, but you had 990,000 of expenses. You only made $10,000 that year. And that's what they use for qualifying. So if you haven't done your 2019 taxes, because we got that extension extended again, you want to maybe create a draft of your tax returns, take them to the lender and say, hey, lender, if I file these, what do I qualify for? And then they'll tell you, okay, you qualify for this amount, and if it makes sense, and you can file. If they say, no, you're claiming too much expenses, then obviously you need to in a sense, bite the bullet and not pay as much or pay more taxes to be able to have a higher qualifying income. So something that's really important. Next is enough assets. So enough assets is, if you're putting, I saw one on the chat, 100,000. Let's talk about that as an example. Let's say if you're purchasing $500,000 house and you're putting $100,000 down, that's 20% of the down payment. They just want to make sure that that money belongs to you, that it's under your account, right? It's under your name, whether it's in a checking, savings, 401k, wherever the money's coming from, that it says John Doe and it has that amount. And that's what's important to them. Now, if it's a savings or your checking, especially checking, they're going to make sure that all deposits in the last 2 months are kind of documented, right? They know where that money's coming from. So ideally, they just want to see payroll type deposits. So you got paid and the money went in there, and that's fine. Anytime you have deposits that are outside of payroll deposits, they're going to ask, what are these deposits for? It's really important because, we get some, nowadays you transfer from Venmo, you have other accounts and money's kind of coming in and out of the accounts, which is fine when you're not buying a house. When you're buying a house, the underwriter's going to look at your 2 months bank statement and say, okay, I see these 12 deposits. Tell me what's deposit number 1. Tell me what's deposit number 2. And so what happens is if it came from Venmo, then they're going to say, well, show me your Venmo transaction history so they can match. And what they're looking for with the Patriot Act is making sure that no one's laundering any money. Now, as long as they're, checks or they're in a different account, that account is good, and we're totally fine. Where it becomes problematic is if you have cash on hand, right? Or if someone's giving you a gift and they said, we're going to give you some cash, then at that point, there's a way of getting it into your account. But if you take hard cold cash and you go to the ATM or go to a teller and say, I want to deposit this 500 or 1,000 or whatever amount, then the bank says, well, where did this money come from? And in the bank's eyes, money doesn't appear from nowhere, right? They always assume if it's cash, there's some sort of loan associated to it, and it becomes real problematic. So if I'm kind of talking to you here and you have cash on hand and you want cash to be introduced into the purchase, make sure you share that with the lender. The lender partners that we work with, they're very direct and transparent. They're kind of on our side. So if they would rather know about the situation than later figure it out. So if that's you, make sure you let them know that. The last thing that they look for is acceptable credit history. And so what does that mean? That's a middle FICO score of 620. So most people will have 3 FICO scores, right? They eliminate the top one, they eliminate the bottom one, and that middle FICO score is what they use to determine your likeliness really to default. And that's what the FICO score is. What's your likeliness to default on some sort of trade line? And so the higher the score, obviously the less questions you're going to get asked while your loan is in underwriting. The lower the score, the more questions that you're going to get asked, because a lower score usually means maybe there might be had been some derogatory activity. The higher the score means there's less derogatory activity that has been there. Now, how do you get your credit score up in a short-term period? So the 2 things that make up about 70-75% of your score is your payment history, which is obviously something that you can't really change while you're applying for a mortgage, right? Because it's all in the past. Now, the other part that you can have control over, what's called credit utilization. That's a fancy way of saying how much is extended to you and how much are you using. So in that, an actual number example, let's say it's a Macy's department store card and they've extended $1,000 to you that you could use. How much of that $1,000 are you using? And ideally it should be 25% or less. So it doesn't matter ever the dollar amount. It's all about the percentage, right? Because someone that's at 90%, meaning they don't have that much room to go, right, is more likely to default than someone that's only using 10% of that money, right? So when you go back to your accounts and you say, okay, let's look at what's available to me on all my accounts. Am I below 25%? And if you're not, it's best that you can shift money or pay stuff off to make sure that happens. This really, on larger accounts, it's harder to do because it's a larger number. But if you have a smaller department store card or just a smaller credit card that's maybe $500, the most you can spend on that $500 card is $125. So for most people say, well, Remo, it's only $200, $300, I can pay it off tomorrow. The amount does not matter, it's the percentage. So you want to go back and make sure that your accounts are below that 25%, that gives you the best score that you can have outside of obviously going back in time and making, if you had late payments, making those on time. So, all right. I'll get to some of the questions after this slide. So after you meet with the lender, and this sounds like it's longer to explain than it is for them to go through, but this appointment is usually 30, 45 minutes. It's typically virtual right now. Some of the lenders actually do have in-person pre-approval appointments. And so again, they'll look at your income, they'll ask for your pay stub, and your tax returns. They'll look at your assets. So they'll ask for a copy of your most recent bank statements, or typically 2 months, and then they'll run your credit. Now, the other question comes up is, hey, I got my score through Credit Karma, right? Or I recently bought a car and they told me my score. Knowing your score is good, right? But the way your credit is ran is also really important, because when your credit is ran through a Credit Karma, they're looking for certain things, right? They're more concerned with consumer debt, and they run it on a different, what's called a scorecard, right? When a mortgage company runs it, they're looking for certain things that pertain to mortgages, right? Where a car company, when you're applying for a car loan, they're looking for repos and stuff along those lines, and they're going to put more weight on that. So the Credit Karma scores and those free sites are a good starting point, but you want to make sure a mortgage company runs it, because they're the ones that are going to, that's the score that's going to be used, not your Credit Karma score. Even if you have a report that says you have a 700 FICO, it doesn't matter what's on that report. It matters on what it looks like when they pull. So something that's really important. So they'll look at your credit as well. And at the end of this meeting, you're going to get one of two things. Do you hear that beep, Kathy, or no? I don't know if it's beep. It's my speaker saying it's dying. Well, I can unplug it. You guys don't need to hear it here. Okay. So at the end of all this, you're going to, again, 30, 45 minutes, you're going to get one of two things: a pre-approval saying, get out there and start shopping. And then it'll tell you how much you qualify for, which is the three things most people want to know. So how much do I qualify for? What's the max monthly payment? And how much cash do I need to close, right? And if you don't qualify, let's say maybe there's a few things that need to be adjusted on your credit, maybe a little bit more savings, whatever it might be. The lender will tell you, okay, based off of what I see, here's kind of your homework and here's a game plan to get you approved. Now, some of you might be right off the gate approved. Some it might be a week, some it might be a month, some it might be 6 months. Maybe you've gone through, you're currently on unemployment, or you've been furloughed, and you got to have a kind of a job, a full-time job, in order to buy a home. So whatever it might be, the lender will tell you, okay, based off of your situation, here's what you need to do to get there. And that's really the important part. It's not, as much as I would love to say everyone's going to be approved, the answer is they're probably not. But the goal is, now that you know what you know, how do you get to that position of home ownership? And that's really the important part about meeting with the lender, because they're going to put you on that track to get there. So, all right, let's answer some of these questions. Kathy, do you want to ask them? Because let me turn on my speaker. It might do that noise again. Go ahead.
Can you hear me?
Yeah.
Okay, cool. One of the questions was about what percentage of my available funds should go towards the home, and how much should I save for repairs?
Good question. It depends. So and I had this conversation with one of our past clients. So if you're a younger person and your income potential is more likely to go up, money is extremely, extremely cheap right now. And so, and here's, if you want to write this down so you can stare at it and be amazed at how cheap money is. For every $10,000 that you borrow, so if you think, should I put $10,000 more or not? That $10,000 payment is $42 a month. So I ask you, would you rather have $10,000 in your account, or and have it for a rainy day, or have a lower payment by $42? Most of us are going to probably say, I'd rather have my $10,000 just in case. And that's just $10,000. If you had $30,000, $30,000 or $120. And the reason why it's like that is because the interest rates are low. Now, if interest rates were at 6-7%, that number might be, obviously would double in that sense. And that might be a different story. So I'm a fan of, having a little bit of a higher payment, because again, your income potential over time is going to go up. Now, if you were close to retirement and you're saying, you know what, Remo, our income is not going to go up, and once we retire, might adjust and go down, then that's a different story. But I mean, it's really important that you don't just buy with what's in front of you now and you say, okay, I make this much, but you know that you're gonna eventually get a raise. And again, you're on an upward trajectory when it comes to your income potential. And that's something that's really important. You're not renting, you're buying something kind of for the long haul, and you want to make sure that that decision is just not based off what's in front of you now. Now, I'm not saying splurge and let's go to Beverly Hills with the helicopter pad. And again, if it's within your means, that's one thing, but generally speaking, you want to just make sure if it's a 2-bedroom or a 3-bedroom and you have 2 kids and you're saying, no, we can manage with the 2-bedroom now, but in 6 months we can't, then I would say, stretch to that 3-bedroom, because you're probably going to be better off in the long term. So, all right. Sorry, long-winded answer.
Yeah. How does co-signing on a house affect the credit check process?
All right. So when you get someone to co-sign, right, the reason why you would get someone to co-sign is because you want to qualify for more, right? So one person or 2 people don't qualify for the house that they want on their own. So you bring another person that would give you additional purchasing power. Now, the way that would only work is if they bring you a net positive to kind of your income and your debt, meaning they don't typically have a mortgage. And if they do, actually, what's the best way of explaining it? If they have a mortgage or if they don't, for every dollar of debt they have, they should have at least $2.25, $2.50 worth of income. So if they have $3,000 worth of debt, they should have at least $10,000 worth of income. If they don't, there's no benefit to you, because again, they're bringing in their baggage as well, in a sense. So ideally, your co-signer should have very little debt and decent income versus having a good amount of debt and a significant high income, because it just becomes really problematic. So the way it impacts, obviously, we would look at their debt as well and make sure you qualify not just with their income, but also their debt as well. And yeah, so I hope that answers it.
What is the minimum amount you could put down on a home and still qualify?
Good. So qualifying, so the minimum down payment typically is 3.5%. So on a $500,000 home, that's $17,500, right? So that's kind of the standard, the industry standard. There's some programs out there that would allow for maybe a little bit less, but generally speaking, you could get a loan quite easily with that. Now, as far as qualifying for a certain amount, right, that all has to do with how much income you have and how much debt you have, right? That's the most important thing. Most banks will look at what's called a debt ratio. So how much income and how much debt do you have, to about 50%. So to make numbers easy, if you make $10,000 a month, right, you can take on $5,000 a month on all your obligations. So your mortgage, your property taxes, interest, mortgage insurance, car payments, credit cards. So $10,000 worth of income gets you to $5,000 worth of debt. So when you say, how do I qualify for more? It's either you increase your income or reduce your debt, right? Those are the 2 things that the lender works with to make those adjustments. So, yeah.
The other question that came in, if you put less than 20% down on a home, can you avoid the PMI? Does the type of property, for example, multi-unit or income property, impact how much you get approved for?
So 2 good questions. So 20%.
That's a true question.
Yeah, 20% is the only way you will avoid mortgage insurance. Now, there's banks out there that kind of dress it up a different way. Well, they'll call it lender paid insurance, right? So you don't pay for it, but rather than getting market rate, let's call market rate 3%, right? If you go and apply for a mortgage, that's typically what you get, somewhere around there. Well, instead of getting 3%, the lender will gladly take care of it. But instead of getting 3%, you might get a 3.5% interest rate, right? So it's buried into the rate, or you pay for it up front as a lump sum, and it's typically 2 or 3%. So on top of your down payment, you might come in with an additional $10,000 or $15,000 that would pay for that PMI, so you don't have to pay it monthly. So there's ways of paying it, but you have to put 20% down to avoid that PMI, or you just get a different version of it than what you think. Now, regarding multifamily, So if you're buying a duplex or a triplex and you're saying, well, it costs more, right? Can I use the rental income to offset and help with the mortgage? And the answer is yes, up to a certain percentage. So they're gonna allow you to use 75% of the income of the other units, right? So if you're buying a duplex and you're living in one, and the other unit, let's say, is $2,000, they'll let you use 75% of that, which is $1,500. That'll be added to your income to qualify for that property. And with a residential loan, you're able to buy up to 4 units. And with the same example, you're living in one and those other 3 units, whatever that rent income is, 75% of that is able to be used for your debt or towards your income, your qualifying income.
Okay, I think the last question that came in is about the housing market. You do cover that a little in the
Yep.
towards the end.
Yep. From Brian, yeah, we'll definitely go through that. All right, what's time is it? 9:30. So my goal is to be done by 2 p.m. Just kidding. By 10:30, because this one will go a little bit longer because of the questions. So if you have any burning questions you want to get and you have to jump off for whatever reason, then just type them in the chat, and every 2 or 3 slides or so we'll stop and we'll get to those questions. So let's talk about characteristics of a successful, unsuccessful buyer. And what our goal is obviously to empower you to make sure that you kind of know all, like you know the game in a sense, right? And so first step is obviously getting qualified and getting out there and getting your numbers in order. Now it's kind of the mindset, you know, what makes a successful buyer versus unsuccessful. So we've kind of identified a few things and put them as a yin and a yang. So one is obviously being flexible, especially in this market, versus the dream home syndrome. The dream home syndrome is, you know, I need the big house with a helicopter pad, you know, swimming pool, and I'm hoping that it could be under 400,000, right? And so we all would like that, or you say, no, I'll pay the $1 million or $2 million. Now, if it's within your means, then that's great. But for most people, we understand that it's typically their first home that they're purchasing, and you know, you build some equity, and over time, you then shift that equity into the next property, and you see that quite often, because when you're in the market, you'll see these types of sellers that are called contingent sellers, meaning for them to sell their property, they have to successfully buy. So that happens quite often in today's market, that they're, again, kind of upgrading their home, or sometimes it's downgrading, right? They have a large house and they're saying our house is too big, and that they're buying something a little bit smaller. I'm laughing because I see the mom in the background. She's like, what are you guys doing? Next is availability. So availability is just the ability to get out there and start looking for a home, right? In this market, it is insane how busy it is. And you would think with COVID and everything going on, you know, why haven't we seen a slowdown in the market, you know, with everything going on? And after the slide, I'll kind of jump in our MLS and I'll kind of show you guys of why this market has held so strong in this time. One of it is the alternative to owning, which is renting, right? If you rent anywhere, and you've seen what happened to rents in the last maybe 5 to 10 years, I mean, they've close to doubled, right? There's, if you're from the Whittier area, the 2-bedroom condos on Catalina, the 1-bedrooms rent for $2,100, the 2-bedrooms rent for $2,500. That's a lot for a 1 or 2 bedroom. So people's alternative is, do I buy or do I rent, right? And I think that has put so much demand in the market. And to top that off, you know, I mentioned that example, for every $10,000, it's $42, $44 of monthly debt. It's because money's really cheap. So the alternative is to rent, and renting is high. Money is really cheap, so it's almost the same as renting. Owning is the same as renting. So the question is, well, why don't I just buy? And so that's what's happening in the market. So with that said, availability means how soon can we get out there and see the property? Now, whether that's virtually sometimes, you know, with Google Earth and Google Street View, you could see a lot, obviously a drive-by, but the goal is to get out there pretty soon. Next is, let's see, focused and targeted versus all over the place. That's just really geographically. What we always say is you want to identify a city or two and see all the options in that city, because most people need a starting point, versus saying, you know what, I'm interested in LA County, Orange County, Inland Empire, right? They all have their benefits and they all have their downside, right? If your job is in LA, right, and the San Bernardino or Inland Empire, it's you're gonna drive, right, and you're gonna probably want to, have road rage and not do well with it over time. So if so that's obviously important versus being in LA versus Orange County. So we always recommend is identify a city, maybe two, and see what all the options are there. And if you're not finding what you're looking for, then move on to the next city versus having too many options and really kind of getting paralyzed and not knowing which direction to go. Next is, we talk about many options. This is more of the property type, right? Whether you look for condos, townhomes, a 2-bedroom house, a 3-bedroom house, maybe units, that question was brought up, and then on top of that, you throw in different cities and different counties. It's very, very hard to make a decision because there's going to be pros and cons. So what we always say is identify that city or two, the bath and bed of the home you like. And at that point, you get out there and you look for that. And you're more likely to find something you're looking for versus saying, you know what, any of these would work, because at that point you're going to get pulled in all these directions and you're not going to be able to make a decision. All right. Next slide. Okay. All right. So any questions here that you read, Kathy, that makes sense to answer now?
Actually, yeah, there's one that says if you wanted to build additions to the home, what's something that they should look for? Or how do you find out about like permits and things like that? Is that
Good question. Good question. And we have a family, I think that Lena's working with, is exactly in that kind of situation where, so the question is, maybe do I buy something a little bit smaller, or maybe the quality of construction didn't look as good as it should, and I'm kind of questioning, is this thing permitted, is it not permitted? So the first part of that is you could definitely add on to most homes that are out there, right? Most cities or county have what's called a lot coverage, meaning how much structure is allowed on the land. And generally speaking, I would say a safe number is about 40%, right? So that means if you're buying in Whittier, a standard lot is 7,000 square feet, 40% of that is 2,800 square feet. So if you're buying a small house, the likeliness is you're not maximizing that. So you should be able to add on without really having a problem. Now, adding is a little, time consuming. You got to get an architect that draws it out, then you got to get an engineer that tells you how to build it, and then you submit and you get a permit. And so that process probably could take, 4 to 6 months, and then building it could probably take another, 2 to 4 months, and obviously sometimes a bit more, depending on the size of the project and all that. But it definitely could be done. Now, permits, how do you find if a house is permitted or additions were permitted? And it's all usually in the planning and building department. So if you go there and you say, hey, I want to check for public records, and I'm interested in buying this house, I would just want to check the permits, right? You don't want to come out and say, there's a room in the back, I want to see if it's permitted, right? Because at that point, that might cause a kind of a nuclear bomb for the owner, and really for you if you decide to buy it, right? You just are coming, you're a fly in the wall and saying, hey, I just want to see what's going on with this house. And they typically have what's called a permit jack. So they put all the permits in one little envelope and they'll just hand it to you. And then at that point, you can look at it. Now, some cities have all their permits online, so it's a lot easier. So City of Los Angeles, Santa Ana, Long Beach, I want to say the county, and a lot of them now with everything closed down, you can email them and they'll email you whatever it is that they have. And that takes a little bit of time, but so there's a way of getting it. It's through the planning and building department of the city. If the property is in the city, if it's in the county limits, like Whittier has a third of the city in the county, then you would go to the county to get those records.
A few financing questions came in, Remo. I don't know if you want to address them now or wait towards the end.
Sure. Let's do it.
Okay. One would be, what are the main benefits of being a first-time home buyer?
I know there's this like glory that you hear. I'm interested in first-time home buyer programs, and the first-time home buyer programs work really well when you're in a buyer's market, meaning that there's more people wanting to sell than more people wanting to buy. But right now we're in the opposite, where for every house, there's 5 or 10 buyers that say, just give it to me, right? And so home buyer programs typically are through some city or county or state, government body, and they're giving some sort of subsidy or some sort of program or help to purchase the property. Well, in this market, the homes are moving so quickly, and really the sellers are able to pick from in a sense, the top offers, right? That these programs that take a little bit longer, that take 45, 60, sometimes 90 days, a seller is going to say, well, why would I entertain that offer when I have someone that's putting a substantial down or willing to kind of close quickly? So even though the programs are going to be available, they're not as practical right now in the market that we're in today. Now, if we see a big slowdown, then yes, these programs, and I'll tell you, when about 10 years ago or 9 years ago, most of our business was some sort of down payment assistance program, enough where I went to the underwriters of the county. Her name is Michelle. I went to her wedding in Chicago. That's how much business we did with them. I was invited to her wedding. And so, but right now it's not in the market because the market is not accepting it right now. So I think maybe a couple years down, if we do see a shift in the market, then, that's a little bit different. Now there's some lighter assistance programs that don't take up as much time that are through the state. Those are a little bit easier to kind of get through. But if you're saying, for example, LA County has a second mortgage that has 0 interest that you get $75,000 as a silent mortgage that you don't make any monthly payments on, but you got to wait 60 to 90 days to enable to get it. It's hard to find a seller that's willing to wait for that amount, and if you were selling a property and you had a cash offer or someone putting 50% down and all these attractive buyers, and then you have another offer that says, we're putting 1% or 3% down and we're using government subsidy, and you're a seller, you would probably go with kind of the more aggressive offers because it's more sure money. Now, if that buyer is saying, well, I'll give you $10,000 or $20,000 more, then that might kind of change things. But generally speaking, those offers are not as competitive right now. Now, I don't want to discourage you from using it or considering it. When you meet with the lender, they're the ones that are going to be able to tell you if you're income eligible, because a lot of these programs are driven by how much income you make. Then at that point, if that's what makes sense and that's the program we have to use, then that's the program we have to use. Just know that it's not as, just because it's available and you're saying, well, this is the greatest thing ever, more people would take advantage of it if that was the case. And that's why you don't see it as often in today's market. Now, I'm not saying ever, in today's market with it moving as fast as it is, it's just not as accepted by sellers as it normally would be if we're in a buyer's market.
Another one, if you get pre-approved in LA County, how would that amount differ if you were to switch to a different county, let's say Riverside or San Bernardino?
Good question. So county, and this is more of an FHA. So there's loan limits on different counties because the median income of that county differs. So LA County and Riverside County have 2 different amounts, and it's significantly less in LA County. It's significantly less in Riverside and kind of the east than it is other places. So I'm just going to do LA County loan limits, county loan limits in California. Here, if I just Googling county FHA loan limits, let's see if there's anything that pops up. So there's 58 counties, darn it, in LA County. So let's see, Riverside County, and I'll give you a real live number. Riverside County, the limit for the loan is $442, right? $442,000. In LA County, it's $765,000. So it's almost half, about 60%. So, when you go to Riverside County, there's cheaper alternatives or there's less expensive alternatives. However, the financing also gets adjusted as well. So that's how it would change.
You're good.
Okay. So let's talk about the home hunting process, and this is probably a good time. One of the questions that came up is, heck, is it a good time to buy now, right? And I think that's probably on everyone's mind to answer, to make sure that's kind of the white elephant. It's like, well, should I wait? Should I buy now? And I think what's important is to show you data, right? And let you kind of make your own decision. So let's do that. Kathy, can you allow me to share my screen? And hopefully this Works with no flaws. So what I'm going to show you guys right now is going to be, yeah, I'm still disabled, right, Kathy? Oh, there it goes.
You should be able to.
All right. Do you see my MLS screen?
Yes, we do.
Okay. So this is the multiple listing service. So when realtors put in homes for sale and through this website, they go through the bazillion websites out there, the Redfins, the Zillow, the Trulia, the Homes.com, the blah, blah, blah. All these sites, they get fed from this site. So, you know, to answer that question, is it a good time to buy? We'll go back 20 years, even through the great recession or depression, no, recession, and show you what happened during that time. And you guys can kind of make, you know, make sense of it however you think. All right, so I'm going to do it in the city of Whittier. So, and I'll explain what I'm doing here. Let me just type this in. So this is for my numbers people. So if you like seeing data, then this is definitely for you. If you're like me and just tell me where to sign, then this might not be for you, but it's good to still see it as well. All right, so what I'm typing in here, so this allows me to go back and look at historical data. I'm typing in, I want to know what closed in 2019 from January 1st to December 31st closed in the city of Whittier. And this number here, and Kathy will kind of put it in the chat. So 1,313 homes, or not even homes, properties. So it could be land, apartments, condos, anything. We're just saying a raw number of how many properties are moving in the city every single year. And we'll do this for 20 years, right? So in 2018, it was 1,305. In 2017, it was 1,315. In 2016, it was 1,410. In 2015, it was 1,485. In 2014, it was 1,303. In 2013, it was 1,474. In 2012, it started, obviously more homes sold, 1,688. In 2011, 1,332. So 2010, we're getting to kind of where the market, some people would say, would have bottomed out, 1,315. And let's see 2009, 2008, where it was really bad. Actually, sorry, 2009. So 2009, still 1,440, 1,415. 2008, where it was a bad time for, say, most people, 1,182. And 2007, where it was kind of all hell broke loose, 1,000 even. 2006, 1,516. 2005, 1,882, so a lot of homes sold in 2005, 2004, 1,809, 2003, 1,969. All right, 2002, almost at the end here, 18, 15, 2001, 1,765, and since we're already here, let's go to 2000 and 1,533. And heck, I graduated in 1999, so let's see what happened in 1999. All right, in 1999 we had 1,589. So you're saying, well, why? What the heck do these numbers mean? What we're looking at here is how many homes sell in the city year over year over year over year. And you could tell even in when things were really bad in the Great Recession, homes are still being sold. And so on average here, it's about 1,400 homes sell or properties sell a year in the city of Whittier, year in, year out on average, right? And so then the question is, well, how many homes are selling a month, right? So if we know how many homes are being consumed by buyers a month, then we can know if it's a buyer's market or a seller's market, because that's the question that you guys, or that we need to know is, should I buy now or should I buy later? So I showed you historical data. Then the question would be, well, how many homes are available for sale today, right? So rather than looking at historical data, now I click on active. So on average, about 120 homes are selling every single month for the last 22 years or however long we went there, right? So in a buyer's market, there's usually 9 to maybe 18 or 9+ months worth of inventory. In 2008, as an example, there was about 12 to 15 months worth of inventory. So in that example of, let's call it 100 homes that sell every single month, there was about 1,500 homes for sale. So if you did this search and you said how many homes are for sale, the results will come back as 1,500 homes. So that's an extreme buyer's market where you're using all these down payment assistance programs, right? When it's a seller's market, it's typically 3 months worth of inventory or less. And some people would say probably 4 months or less. So again, if we're consuming 100 every single month, that would say a buyer's market would be homes that are 300 to 400 homes or less, make it a seller's market. So if I come here and I look at active, there is 66 properties in all of Whittier that are for sale. So that means that inventory levels are 2 weeks. So if no new properties come on the market in 2 weeks, there's no more homes for sale in the city of Whittier. So that is the true definition of an extreme seller's market, meaning more people want to buy than more people want to sell. So to answer the question, where do I see it? The market in the next 6 months or year, I still think it's really strong. Again, the alternative for people is, should I rent, right, and pay the same as my mortgage, or should I buy? And so with supply being as low as it is, the prices will continue to rise. And so the question is, how soon, is it a good time to buy? My answer would be if you're able to buy, right? Because there's very few homes that are for sale. So, and this is where, more so than ever, the relationships with the realtor and the community and being able to have kind of get in opportunities before they happen is really important, more important than it probably has ever been. So 66 properties in the whole city of Whittier that are available for sale. So not what you would expect in the middle of a pandemic. And you say, well, why is it like that? And the answer that I think, in my opinion, is real estate is a slow moving asset, right? In the financial market, if you have a stock or a bond, right, and something happens and people sell really quickly because it's a couple clicks. When you're selling property, it moves a little bit slower. So even though we had the shutdown, people were like, well, should I sell my property? By the time they realized maybe they should or shouldn't, the market started coming back and started roaring. So I think that has helped real estate, that it moves a little bit slower, where in the Great Recession, it was 1.5 years, 2 years. And so, we're in it a lot longer, and there was a lot of homes for sale. All right, let's move on. I could keep nerding out on all this stuff if you guys have more questions. All right, Kathy, I'll give you back the thing to share.
Thank you.
All right, viewing homes with our team. And I think this is going to be more around, what's the protocol to look at homes during COVID? It's very logistically intense right now. And what I mean by that is, every single property that you go see, you have to sign a form that you are confirming that you do not have COVID, you haven't been in contact with someone that has COVID, you don't have a fever, and a lot of other laundry lists. Every single home you see, a form has to be signed. So again, logistically, if you say, hey, team, we want to see these 3 homes or these 4 homes, and we say, great, here are the forms to sign, right? Individual form. And then we take that, then we make the appointment with the agent, then they confirm that appointment, and then we can go see it. So in the past, it was just a lot easier, where the agent said, yeah, go ahead, the property's vacant, or, without any forms. And I think, agents, generally speaking, are not good with the logistics of moving paperwork. I mean, that's I think the truth. And so when you add this level of paperwork, it just makes things a lot slower. So so anyways, that's something that has happened. So you have to wear a mask. Most places are requiring that you wear gloves, you wear booties. You're limited to 2 people into a home at the same time. Sometimes there's limitations on the showings that are back to back until the house is sanitized. So it's not as easy as it used to be, where you could just go to an open house. So open houses don't exist. Now you'll see a lot more virtual, tours where you have these 3D Matterport, or kind of a Google Street View inside of a home, and we do it for all our listings so people could see every inch of the home without physically needing to go there. So there's a lot of that, but there's still showings that are happening, and it just with our team, our goal is to kind of identify the ones that make the most sense, and obviously visit those, because it's not in the past where we used to go out there and look at 10, 5, 10, maybe 12 homes in one kind of afternoon or one morning. That's not the case, is because things take a lot longer, and a lot of times listing agents, for a property that we have right now in Long Beach, they're time slots, right? We say we have a 10 o'clock and a 10:30 and 11 a.m. Which one do you want? And so you might be seeing homes in the afternoon, and so to get to that one, you kind of have to go out of your way. So that's what the market is now, and you kind of have to be adjusted to that. One other thing that's really important is on the consumer sites. You go on Zillow, Redfin, and all these sites, and obviously there's some pre-foreclosed homes that are on there. Pre-foreclosed homes are not for sale, right? What happens if you don't make your mortgage after 90 days, the lender has the ability to start the foreclosure process. The first step in that is called a notice of default. So they go to the register or recorder office, file this notice, and now the lender is giving you notice that you are in default, right? And it's a public notice. You get companies that go to the register or recorder office, they collect these notices, they go to Zillow and say, Zillow, here are the last 20 homes that are showing up as a pre-foreclosed home, right? These pre-foreclosed homes, typically 9 out of 10 times, probably even higher than that, the seller, one, maybe doesn't know that the property's there. Maybe there's some sort of distress situation. Maybe they've been furloughed. I mean, with everything going on, but they have not met with a realtor and said, I want to sell our home, right? And that's something that's really important. Just because maybe a significant, someone passed and that's the reason why they didn't make the mortgage payment, whatever it is, at the end of the day, it's not a home that's for sale. Now, with, another reason to work, with kind of an agent during this time versus looking online is, I would say a chunk of the homes are not available on the MLS. Kathy, can I get the screen back? Let me show you one home. So I showed you guys active homes. Let me see. Okay. The other homes that are available that you don't see are homes that are put on hold. You can see my screen, right, Kathy? Okay. So I showed you active homes. Now on here, there's this slot called homes on hold. So there's 31 homes that are on hold, and then there's 66 homes that are active. So almost half of the home, an additional 50% of homes you are not seeing on the market. So let me show you what that looks like, because these are placed on hold. Once they're placed on hold, these homes do not syndicate with the consumer sites. So let's try one of these. All right, let's see orange. So this home, nice home, $699 with a pool, was placed on the market, was on the market 4 days. Now, if I go in and I say, okay, let me go look at this home on Zillow or any sites, I'll open it on Redfin, Zillow, and you'll see it's off the market. Even though there's pictures, it says off the market. Redfin, it says closed back in 2011. So it doesn't even show on the market. So these homes that are placed on hold, they're not syndicated with the consumer sites like they used to be, or that they have been. So something that's really, really important, more reason to work with an agent, obviously us or someone else, but you don't have access to these. And so half of the homes you're not seeing is kind of a big deal and an important thing. All right, so I just want to share that with you because that's something that's really important. All right, next slide, Kevin. All right, so once we're all done with the workshop, if we were in an in-person workshop, we would play this 8-9 minute video. This is a video of us walking a property and pointing out the important things in a home. When people walk through a home, they tend to look at personal property. Maybe you look at the pictures of the wall, you look at how nice the couch is or how not nice the couch is, right? Maybe they're cooking something and you just can't, you're like focused on, I can't believe they're cooking that, or that smells really good. Whatever it is, you kind of lose track of what it is that you're looking at when you come look at a house, right? So the example that we share is, imagine I have the house in my hand here. If I lift up the house, anything that I can shake off the house and anything that falls out of the house is not part of the sale. Anything that's fixed to the house is part of the sale. So landscape, what else? Light fixtures, window treatments, anything that's attached to the property is part of the sale. Anything that's not attached to the property is not for sale. So appliances are obviously in the gray area there. Some appliances are part of the sale if we ask for them in the contract. So when you're walking the property and you're saying, hey, this stove is really nice, or this refrigerator is nice, I want to make sure to include it, then you let us know, so we make sure there's a box that's checked that we're saying we're asking for that as well. The other things that we want to really look for, and it's kind of a list on the left here, are going to be the stuff that's going to cost you some money. So it's the major systems, it's the roof, it's the what else? It's the plumbing, it's the electrical, you know, it's block wall fences that are around the perimeter. These are the things that are going to obviously cost you some money. You see staining in the ceiling, you know, the windows single pane, you know, especially right now, especially today, it's supposed to be 1,000 degrees outside. And so you go to a house with a single pane, you're definitely seeing that they don't have AC and they're probably not insulated as it should be. So these are things you want to kind of keep an eye out for. When you look at that property and it's 70 degrees out and it's nice, that stuff kind of goes out the window. But when you're going through and seeing, and it's 100 degrees outside, you notice air conditioning. And we tell that to our sellers all the time. There's been times where we sold properties that didn't have AC, and it was in the middle of summer, and we said, you know what, you have to put AC, because you walk in and it's 90 degrees in the house. It doesn't matter how nice the house is and the price, people just it's unbearable. And so there's been a couple times where they put full-blown HVAC systems that made sense. So this video walks a property. It's Francisco and Mary. They walk through a property and they'll point out different things. So you'll get this once we finish the workshop via a link. All right, so to kind of bring us up to this point, so we got approved, we got some good characteristics of what it looks like to buy. We're out there, we start looking, and then we come across the home and we say, you know what, we like this home, let's make an offer, right? So the question is, how do we determine the offer price? And I think that might have been one of the questions, and Kathy, if it is, let me know and I'll elaborate on it. But what price do we offer, right? Let's use an example of a $500,000 house, right? That's what it's on the market for. And so do we offer 500? Do we offer 501? Do we offer, you know, 600, 400? What amount do we offer, right? How do we get to that amount, right? And so the answer really is getting an idea of why the seller is selling and having a good conversation with the agent, right? Our goal is to kind of ask every and any question around price so we can know what we're competing. Our goal is to really, as much as possible, and it's not ethical for the agent to share that number, but is to come back to you and say, okay, from what we were able to kind of put together, here is what we think, you know, where the competition is, right? And at the end of the day, buying a house is a competition. We're competing with other buyers. And the question is, what it would be the most competitive bid to get this house, right? And that's our goal, is to try to get that number out from the other side. Now, the marketing price of the 500,000, that's just where the price is. I don't know if any of you have seen we have a listing that we just listed, in Thursday, I think. It was in Long Beach. And so we put the house on the market, and I'll give you kind of an example of what the conversation with the agent would look like. That property went on the market. Some agents reach out to me and they're saying, okay, well, we'll submit an offer. They didn't really ask questions about it. And, you know, they're going to submit below the asking price. But if they were to ask some more questions, you know, one of the things that one of the agents asks is how much interest is in the house, right? And so we've had, I want to say 26, 27 showing requests to see the property. That's a lot of people coming into a house. And obviously when a lot of people are looking at it, you know, more offers are going to come in and it's going to help drive the price up, right? That agent never asked that, never really, they said, well, do you currently have any offers, right? And that's like a piece of the pie. It's how much activity, when is the seller looking to make a decision, what's important to the seller, do they want to close quickly, do they want to close, you know, 60 days from now, all these questions are really important. So when we put together an offer, we're kind of making sure we meet on multiple points that the seller is looking for. So that's something that's really important, and that happens with the conversation with the agent. Next is days on market. You know, has it been on the market for 2 days, or has it been on the market for, 2 months, right? And they haven't adjusted the price. Obviously, a property that's, in our situation, that Long Beach property, been on the market 2 or 3 days. There's, we're gonna not have an open house, but we're gonna, on Tuesday, the family's gonna be moved out, and my thinking is we're gonna probably put up some sort of canopy and let people in every 30 minutes with an appointment. And when they see that, then they'll know it's really competitive. But unless you ask those questions, you're not going to know what's the environment that you're walking into, and that's something that's really important, especially if you want the house. Now, if you're just kind of looking and you want to see what the market really looks like, then it might not be for you. But if you really want to put together a winning bid, then you want to know all these pieces as much as possible. Next is comparable homes. Property condition, all these things obviously play a role in determining the overall price. If there's multiple offers, or they expect multiple offers, if there's no activity on the property, right? If they don't have any offers, like a home that priced really, really high to begin with, and they don't have any offers, they've been on the market for some time, if they don't have any activity then, or no offers, then we don't have to be as aggressive. But if it's, for example, in that Long Beach house, we listed at 540, I would think we're going to sell somewhere in the 560, 570 range. And that would be important for the agent to know, because if the buyer is saying, well, I'm only willing to come in at 525, then it won't happen for that property, right? That's the goal, is to get, again, as much data as possible. Next is, do we ask for closing costs? Now, closing costs, we didn't mention this up to this point. Closing costs are the costs associated with financing. Right? So it's your finance costs, right? So if you're buying a house, let's say at 500,000, and you're doing $100,000 down, that's 20%. That's your down payment. But on top of that, you have the costs associated to obtain financing. Now, those costs are the county charges to record documents, the county, what else is the county? The notary charges, the title company that ensures that the property is free and clear of all liens charges, the escrow company that at the end of the day make sure you get the keys and the seller gets the money, they charge. What else? There's a handful of other things, typically speaking. And then the biggest part of that is your lender. When you're getting a loan from your bank, the salesperson, there's a charge for their loan as well. So all these little things kind of add up. Usually it's about 2% of the price, the purchase price. So in that example, 500,000, you're putting $100,000 down, which is 20%. In addition to that 100,000, you would probably need another, I would say, $8,000 to $10,000 for the cost of your loan, and that's a one-time cost for obtaining the mortgage. Now, the question is, well, can we ask the seller to cover some of those costs, right? And the answer is, if they have no activity, they haven't reduced the price, and we have a chance there. If we have 10 offers that we're competing against, then the seller will always look at their net number, right? So if we're offering 500,000, but we're asking them to give us $5,000 back to help offset our closing costs, then we're offering them 495, right? And so, in this market, it's not common. I would say every so often it is, but really, to be just truthful, it's very hard to get closing costs right now because it's so competitive, right? A seller is looking at kind of the extreme where buyers are saying, well, if it doesn't appraise for the price that we said we're going to pay, we'll come in with the difference, right? Or they'll buy the house as is. Those are the types of terms that we're seeing in today's market. So again, it's very competitive because there's a lot of people that are interested in buying, and there's not too many homes for sale. And then the last part of this is, are we going to receive a counter offer? Can we send out an offer and let's see how it goes? And the answer is, the seller is not obligated to send us a counter. Just because we make an offer, the seller, all they need to say is, your offer was presented and it was rejected or not accepted by the seller. And that's all they really need to tell us. So our goal is to always put our best foot forward, and kind of how we started this slide is, we want to kind of know what the winning bid is, and we either are going to compete somewhere near there, or just doesn't make sense, and we move on to the next property. So yeah. All right, Kathy, any questions? Any more coffee?
Yeah, so there was a question of when we sit with an agent, will they be able to help and teach us how to run numbers for home values and, like, for example, per square foot compared to comps, like understanding that a little bit more?
Yeah. So here's my unfiltered truth is price per square foot and all this stuff that is normally logical does not have any weight in this market. Because if I have a property, right, and I'm selling it for $500,000 and I have 10 people that are saying I'll give you 510, 520, 530, if if you're if you're trying to calculate what price per square foot is, there's like 9 other people that are just saying, give me the property. And that's what we're in right now. You could definitely look and we'll share that price per square foot, but like we're going to be talking about something that's not relative to the market that we're in today. Now, again, 6 months, a year from now, if we see, you know, I don't know, 500 people come all of a sudden and put their house on the market in Whittier, then I think that slows down the market a little bit. But with everything kind of happening and where we're at, I don't see that happening. So yes, price per square foot is important. It's more important when there's enough sellers and enough buyers. So if we were at a market where there's about 6 months worth of inventory, so about 600 homes in the city of Whittier for sale, then there's enough buyers and enough sellers where that logic kicks back in. Right now, homes are like, and I know this is gonna sound stupid, homes are like toilet paper when it was in March, right? It doesn't matter what the toilet paper costs. You know, single ply, you'll pay $2, where in the past you would never buy single ply, right? That's the kind of market where, and I say that sarcastically, but really that's really the truth. So the logic of us going and saying, you know, this is too expensive for this toilet paper, the guy's gonna say, well, move out the way because I want that toilet paper. And that's, again, I say it sarcastically in a joking manner, but that's really the environment that we're in now. We will definitely still look at the price per square foot and everything like that just to make sure that it's within reason. But at the end of the day, if you have 5 people that are willing to buy that toilet paper and don't care if it's single, double, or triple ply, then that's what we're kind of in. So, but that's a really good question, and that data is available. We'll look at it, but it doesn't have bearing on the seller's decision to move forward with us or the next person.
Another question you'll be covering on the next slide, but just so you know, besides offering more than the asking price, is there another strategy for making your offer more attractive to a seller?
Yes. All right, so this is a slide that we'll actually talk about that. So we get to a price, and let's say it made sense for us to offer 525 on this house, right? We had a conversation with the agent. He says, you know, we have some offers. You guys will be pretty competitive to the seller. So how do, at that point, we know the offer, how do we make our offer stand out? And this is kind of where some of the magic sauce or the secret sauce is, right? So the first thing that goes in the offer package is going to be, or 5 things are going in the offer package. The first is the residential purchase contract. So that's the actual contract. That's the nuts and bolts of everything. So that's who's buying, what price, how long is it going to take to close, what kind of deposit, what are the contingency periods, right? How much time you got to kind of do homework on the house, when possession would be when you close, how soon you get the keys, who's paying for what fees, and so forth. So how do we make an offer more attractive? So this is where these are the levers that we can kind of pull in different directions that are going to make our offer more attractive. So the first part, and we'll kind of go through maybe 5 of them, is going to be the deposit amount, right? So your deposit, when you open up escrow, is typically, I would say for most people, is going to be $5,000 to maybe $7,000, right? That's a deposit that's placed in escrow, and that amount goes towards your purchase. So it's not money that you're kind of given away, but that money is going to kind of secure and is a consideration to kind of buying the offer, right? Now, that $5,000, if for down the line you don't perform and you release your contingencies and you don't move forward for whatever reason, the seller keeps that $5,000 as compensation. Now, I don't think ever have had anyone lose their deposit, but if that amount is, instead of $5,000, it's $10,000 or $15,000, the seller knows, hey, these people are really serious because they're willing to put up $15,000. That's a big number. So that's one way, increasing your initial deposit. Obviously, the lower the number, right? There was decades ago, Fannie Mae, when there used to be REOs, they would allow first-time home buyers to only put a $500 deposit, right? $500. So for most people, if they lost that $500, they're like, it's not important. So they don't have that much skin in the game. When you're putting a $15,000 deposit, you know, you're definitely committed, because no one wants to lose that $15,000. So that's one way. Next is you shorten your contingency periods. So your contingency periods is the period that you have in order to do homework on the house, right? That's when you're going to do your inspections, your appraisal, your review the documents, all this stuff. Naturally, it's anywhere from 17 to 21 days. If we come back and we shorten that period and say, you know what, seller, we're going to do all our inspections right away, and we're reducing our contingency periods for inspections to 10 days, right? That's kind of a good assurance to the seller, because what ends up happening is they're going to know if you're committed and you're serious within a shorter period of time. So that's obviously going to be more attractive to a seller versus someone that says, no, I need all 21 days. Actually, can I get more than 21 days? Can I get 25 days? That means they're going to be committed to us this time for 25 days. And if we cancel, then they will not get a deposit. They will not get anything, because we're within our contingency period. So another way of improving our offer is reducing the contingency periods within the contract. Obviously, the price, you know, sometimes it comes down to that the bottom line number. It's the price. There's no, you know, way to dance around that. I mean, if someone's offering you $20,000 more and the next person, most, you know, sensible people are going to say, I'll get that $20,000. So that's one way. Another way of improving is obviously, and one of the things we recommend in the beginning is obviously getting pre-approved. That shows that you're eligible and you're able to obtain financing, and you've gone through the process, provided your tax returns, your pay stubs, your bank statements, all that to a lender, and they've issued a pre-approval letter. So that's obviously an important thing. Other things that we give to the seller or to the agent when making an offer is evidence of your funds. So if you said you're putting $100,000 down somewhere that has your name, you have that money on paper. So if it's your bank account, your savings, your 401k, whatever it is, we show that. The more money that you show there, obviously, the more resources you have. If you are just have, you know, a smaller amount down, then obviously if we're competing against someone that's putting a substantial amount down, then they're going to look stronger. So our goal, even if we're not using it, if you have 401k, if you have a 403b, any account, we just kind of share everything. Even though we're not going to use it, the more resources someone has, the stronger that they ultimately will look to the other side. Next is the first page of your credit report with everything whited out. And that's to show that you have credit scores that are in the acceptable range. Obviously, the higher the scores, the better. The lower the scores, we kind of, and as long as you're still able to obtain financing, we kind of put that in the back of the offer package. But if it's, you have good, really high scores, and it kind of goes towards the front. And then the last thing that I think the most important thing outside of price is going to be a letter to the seller. And I think it is so underestimated how strong, how much of an impact how far a letter can go. And I'll share with you guys a few personal examples of a letter. You know, from a seller standpoint, let's kind of look at it from there. If you're receiving 5 offers, 7 offers, at the end of the day, you know, you're not in the business, you're looking at price, how fast can they close, and any costs that are out of the ordinary that are we going to be associated with, right? So when you're reviewing 5, 6, 7, 10 offers, that's really what you're looking at, right? It's very black and white, and it's not as connected. Our goal is to make sure we write a strong letter that really pulls on those heartstrings, right? Generally speaking, from those, let's call it 10 offers, maybe 2 or 3 write a letter, right? And if you're a seller and you're looking at these offers, you know, you're going to look at those items that I mentioned, but you're really going to look at the story. If someone writes you a letter, you're going to probably read it. And we've had, I don't know how many times where the best offer wasn't the one that was entertained first. So we sold a house in Whittier. It was like November of last year. And so we received 9 offers. This property was on Colon. And from the 9 offers, the 8th worst offer, or the 8th worst offer, or the 8th offer from the 9, right? They wrote a letter and they said, you know, grandma lives 2 blocks away. The kids go to that school. Grandma takes care of them. And the sellers read that and said, oh man. And I think they ended up going to the same school as their kid. And so they said, well, you know what, can you go back to the Joneses, and won't know what their name, we'll call them the Joneses, and see if they're willing to come up to that price, right? And so we went back to them, and it made sense for them to come up, and they ended up getting the house. They were not the first offer, the second offer, they were the 8th out of 9. I mean, that's naturally speaking, if they didn't have a letter, they would have been just kind of written off because there were stronger offers to begin with. However, that seller liked their letter and said, you know what, let's go back to them, and we did. And so, and there's many examples, not just on the purchase, but also when it comes time to doing inspections and other things that kind of come through the process. You want to share your story because most people have memories in the house, right? And they want to transfer the property over to someone that's going to, you know, not turn it into a rental because, you know, they have memories there. I mean, speaking as me and my wife as new parents, you know, we brought our daughter here to the house. First time she threw up was on the couch, and, you know, you have these memories, and that's what you want to kind of transfer over to someone that's going to take care of the house, kind of like what you did. So the strong letter at best is the best way to explain it is it gives you the last at bat, right? It doesn't matter. That family could have very easily came back and say, no, we don't want the house, but they were considered, right? And that's what a strong letter will allow us to hopefully do, is to get that call and say, hey, this is the price. Are you guys willing to come up? And at that point you say, yes, we're willing to come up, or no, but to be asked is a really important thing versus saying, oh, your offer didn't get accepted, go on to the next one. Oh, your offer didn't get accepted. So that's what a strong letter does. You know, when walking through the house, you kind of want to identify a few things. Maybe, you know, you have family in the military there, you see pictures of the military. Maybe they have younger kids that are the same ages as your kids, or, you know, the goal is to try to connect with them on as many levels as possible. Now, if you say, hey, I'm not the best writer, or I don't really have a good story, don't worry. We have many letters to choose from that our past clients have written, where you can kind of make adjustments, but the goal is really to put together a letter that's going to appeal and pull on those heartstrings. So, all right, Kathy, did I answer? Is there any new questions that came out of that?
Not out of that, but from earlier, someone did ask about investment properties. So, for example, this letter, I know you mentioned pulling on heartstrings and memories. What if you're looking to invest in a rental property?
I'll give you, I mean, so the letters still work because my brother is single, didn't have no kids, no animals, no cactuses, nothing. We got pictures of my nieces and nephews, talked about Mrs. Future Ride, gonna get married in the future. I'm not saying lie on the letter, but, you know, but we're not gonna say we're a mean landlord and we're gonna, you know, whatever tenant you have, we're gonna kick them out and do all this stuff. You just wanna obviously be as pleasant as possible. And even for rentals, you can still do it. You could say, hey, it's my first property. I really like it, my first rental. And I'm here's a picture of my house. This is what it looks like. This is how I kind of maintain things. I want to make sure, I want to do things right. There's ways of kind of around that, even for an investment. All right. All right, so we get to this part where your offer gets accepted, right? We make an offer, they like the letter, maybe there was a counter back and forth, but we came to terms and the seller accepted our offer. So what does that mean is, you know, they signed the offer that says that they're gonna sell to us. And during this time, they cannot, at that point, accept any other offer. If tomorrow, after they sign our offer, they get an offer for $10,000, $20,000 more, they can't do anything with that offer because they're committed to us, right? And during this time, that's when the deposit goes into the escrow company. And once your offer gets accepted, this is what's called opening escrow or being in escrow, right? You now formally got your offer accepted. So now what? This is the stressful time of buying a home. You know, when you're looking online and it's not as threatening because there's no money exchange, right? This is, when you're looking online, it's kind of fun and easy. But when you're buying a house and you're in escrow, there's a lot of moving parts that you want to make sure you're on top of to make sure it's as less stressful as possible. So the first is you meet with the lender partner again. So the first time you met with them, maybe it was a couple months ago, maybe even some time ago. More importantly, all the stuff that's typically in their file has to be within 30 days of being on the market, of being current to what they have. So your pay stubs, your bank statements. If you met with them 2-3 months ago, then obviously the stuff that you gave them is expired. And so they will collect new stuff. What else? You'll fill out the loan application with that property address that you're buying. What's really important when you meet with the lender early is the lender is who orders the appraisal, right? It's not the realtors that do it. It's not the seller. It's not you as a buyer. It's the lender. In that example that we use of the $500,000 purchase, you're putting in $100,000. The bank is putting up $400,000. Well, the bank wants to make sure that the property is worth whatever it is you're willing to pay for. So they're the ones that send the appraiser. Your bank does that sends the appraiser. Next is you conduct your inspections. And so regarding inspections, inspections are an investment that you do into the property to see what it is that you're buying, right? So when escrow is opened up, you'll receive an email from our team saying, hey, here are the 50 or so in different type of inspections you're able to do. Each of them have a cost associated with them. Most people start with the general home inspection. The general home inspector will go on the roof, go in the attic. If there's a crawl space underneath the house, go underneath the house, open and close all windows, doors, check all outlets, all switches, go shake any block walls or any fences. And at the end of all this, they give you a report of what's wrong with the property, or areas of concern, I should say. What else? Now, the cost of the home inspections, there could be anywhere from $250 to maybe $600-700, depending on kind of the bells and whistles that they have. So some of these kind of additional equipment that they have or don't have would be a snake with a high definition camera. So normally if you have a clogged pipe in your house, or your lines are backed up, you call the plumber comes with a snake. It has a blade and they'll run it all the way through and kind of clear whatever clog is there. They have the same thing, but instead of having a blade, it has a high definition camera. So they can run through your sewer lines and see if there's any root intrusion or anything that's separating. Maybe the pipes have separated. And so if you don't have that equipment, there's no way to obviously see that you have that. With the camera, they could go down and it tells you exactly how far down. So at 71 feet from the entry point, they know that there's root intrusion there. So you would be able to kind of dig or do whatever you need to do to kind of fix that. If you have a big tree in front of your house, and that might be a wise thing to do. But that's kind of an add-on if you decide to do it. They have thermal equipment that can kind of scan an area. They do it for air condition as well to see if there's any leaks. What else? So there's many kind of add-ons or things that you can inspect for. Each of them, again, have a cost. Most people start at the general home inspection. And then from there, the inspector might say, you know what, the roof looks a little kind of on its last leg. The electrical, there was stuff in the attic that looked like it was, not done to code, whatever it is. The goal is you want to get a sense of what it is you're buying. Now, probably one of the most important things that I could tell you at this workshop is the way the purchase contract is written is that the property is sold in its as-is condition, right? That's really, really important. That doesn't mean we make an offer and the seller is allowed, we go back to the seller and say, hey, the home inspection had these 20 things, we want you to fix it. It's really important that you understand the property is sold, and that's the way the contract is written, in its as-is condition. Very similar to buying a used car, right? You could take it to the mechanic, and the mechanic can tell you it needs, it has 40% left on its brake, two tires need to be replaced, you need oil change, whatever it is, right? Same thing when it comes to buying a house, right? The seller is not going to make the repairs, all the repairs that are on the list, because again, and if you're buying in Southeast LA County, in Whittier, for example, homes were built, generally speaking, from the 40s to the 60s. So it's 60 to 80-year-old home. So most likely the roof is not brand new. Most likely the water heater is not brand new, and so on and so forth. So what's important is with that kind of inspection, it's to get a sense of what it is we're buying. Now, don't get me wrong, we definitely take the reports that we get and we go back to the seller and we say, hey, seller, we thought everything was kind of hunky-dory and we want to, we still want to move forward, but there's a future expense that we have, and we're asking for a credit, right? For you to give us kind of some money to offset this future repair that we have to do. Or maybe we ask for the specific repair to be done, or a combination of the two. And we will do that, but it's important that the seller is not obligated to do that for the home to sell, right? And again, in a seller's market, it's less likely that a seller will do certain things. Now, if there's a leak underneath the house, or if there's a health and safety issue, then obviously that's something that they're more likely to do. But if you don't, right, then I think what's important is we just go in the purchase knowing that, because that's really important. Now, we sometimes get, well, my uncle bought 10 years ago and he got this and this. Well, we're in a different market. If your uncle bought, or I say uncle because my uncle tells me that, right? When he bought 10 years ago, the market was completely different. There was many homes to choose from, and sellers had to kind of make these concessions for someone to buy their house. Sellers now don't have to do anything, and their house still sells for top dollar. So, but again, we'll use these things to negotiate as much as we can. And if it doesn't make sense for whatever reason, maybe there's an issue, maybe there's a crack in the foundation and we just don't feel good about it. Maybe the electrical is kind of, really shoddy, and it just, one of the homes that we're selling right now, we're representing the buyer. The home was built in the early 1900s. Back then, they used this electrical wiring called knob and tube. It's very similar to what you see on top of the power line, where it's just a wire and it wraps around a circle and it kind of keeps going. Well, that wire is exposed, right? So if someone touches it, you get electrocuted. In the 1900s, that's how they built the wiring of a house. So underneath the house, that's exactly what it looks like. So there's no covering. So we asked the seller for that, and I think we're able to get a few $1,000 credit for the buyer to go in there down the line and make those repairs. So any questions about inspections, drop them in the chat. We'll try to get you out of here in a decent time here. We're a little over. I got Kathy's hurry up message. Next is the disclosure. The disclosures are a series of questions that are asked of the seller for your benefit. Now, these are practical questions that typically an inspector is not going to know because he doesn't live there. The most practical one, or the most important one, I should say, is if there's been a death on the property in the last 3 years. It's state law that the seller discloses it. So that's what most people want to know. If there's been if any of the property's been paid in the last 12 months, if there's been an insurance claim in the last 5 years, is there anything known that's not working? Is there any ongoing treatment that needs to be done? We talked about the sewer line. Do they have to clean it out every 6 months because it gets clogged? All these things are asked in this questionnaire, these series of questionnaires that are going to be given to us. Now, we get to a point where, let's say we're 15 days, 17 days in, and the seller comes to us and said, we've given you the time to do all the homework, all the inspections, go to the city, go to the county, whatever it is, and we want you to release your contingencies. That means you're signing a form, and on this form, you're saying that you are releasing your claim against the deposit. So if you don't move forward from that point, then the seller keeps that as compensation for keeping the home off the market. Because again, when our offer gets accepted, they're not entertaining other offers, or they can't accept any other offers. So they're going to get to a point where they're going to say, well, we need you to kind of push your chips in and let us know that you are all in. Now you say, well, what could happen at this point? Once we do the inspection, the appraisal, everything kind of checks out. I started the conversation today with the employment. This is where the lender will do a last kind of verification of employment, and you have to have a job through the whole process of purchasing a house. Even if, and when I say job, I should say your employment has to say the exact same. So if you're working 40 hours, you remain working 40 hours to the end, right? You can't get furloughed, you can't take a forced day off or whatever it is, because that really will change things. And this is where your deposit would potentially be at risk for that reason. But let's say everything checks out, you're an essential employee, or let's say you're a nurse, and and you have, your income is not going to change and it's probably going to get better. Then we release our contingencies, we kind of again push our chips in. You get to a point where you sign your loan documents. Once you sign your loan documents, this is when you bring in the remainder of the money. We talked initially about just putting in a deposit. In that $100,000 example, this is where you bring in the bulk of the money. So if it's $110,000 altogether, and you put a $5,000 apart, this is where you bring in the $105,000 really towards the end. And then you sign your loan docs. These loan docs are, again, the formal documents that you're going to sign to kind of take on the mortgage. From that point, usually 1 to 3 business days, depending on the bank you're working with, the bank funds their loan, meaning the money that you're applying for makes it to the escrow company. So once the escrow company has your money, has the bank's money, they'll let the title company say, hey, title company, we have all the money, we go ahead and record the grant deed. Now, in LA County, it's typically the next day that the grant deed gets recorded. Once the grant deed gets recorded, that's when you become the official owner of the house. And in the contract, we talked about possession, when you get the keys. You know, if it's 1 day, if it's 3 days, because the sellers are kind of vacating and moving out, that's when you take possession, and that's when you get the keys, and whew, that's when we party. So that concludes the workshop portion, and I know we have a couple questions. Now, I know we went a couple minutes over, and I asked for you guys humbly if you entertain me for like 2-3 more minutes, because the question is, well, why us, right? So this was the home buying process, and this was kind of going through in today's market, what the market looks like. But you know, the question is, Remo, why are you guys so awesome, and why should we work with you, right? And so let me tell you why, since you asked. So realtors, they do many things, right? Realtors, and Kathy, if you can help me with the mouse, starting from left to right. So they present contracts, they go to inspections, they list homes, they attend closings, they show homes, they're at the appraisals, they answer some questions, they used to do open houses, they make brochures, they put internet ads, they write newsletters, they answer their pagers, right? These realtors are just busy people. Working with our team, you work directly with a buyer specialist. And I know Francisco, Alina, and Rebecca came on here and kind of talked. Why is that important? Well, right now in today's market, or just generally speaking, they don't do the A to Z through real estate, right? They do the J through M. We have Kathy on the administrative side and Jessica as well. And then to help with all the administrative stuff, and then anything that has to do with sellers, I'm the one that kind of takes over. So their time is dedicated directly for you. So for accessibility and to get out there and see properties and to build relationships locally. Next is knowledgeable in the area, experienced team, strong social media. I saw in the beginning when we asked that question, how you heard about us. Some of you said Facebook and so forth. Well, and that's great. And what's important is you as an end consumer sees us on there. Other agents also see us on there. So if we're making a call to Joe the agent, right, and Joe has heard about us or seen some of our stuff, he's going to probably be a lot warmer in our conversations than if it was just a random person that he has no relationship with. So we leverage our relationships, especially in this market, more than ever, right? And I can't stress how, like the last 3 offers we got accepted is because we knew the agent. You know, we made a call, we said, hey, here's our buyer, here's our situation, because we do a good amount of business in the area, and we have a good reputation on kind of getting the ball all the way past the goal line. Where if you're an agent and you're accepting an offer, would you want someone with a good reputation and someone that you know will get the job done, or just kind of a newer agent, or an agent that doesn't do as much business, or what have you? And so the answer would be obviously someone that you know is going to get the job done. So with that said, us leveraging their relationships, what's important to us though is what leads us to our #1 goal of our customer service and our goal to create raving fans. Now, if you've seen us on Yelp, maybe some of you have, we have almost, and it gets whited out because every time we do a workshop, we update the number, close to over 180 5-star reviews on Yelp. And if you do anything on Yelp, obviously, you know that that's kind of a tall task to take on. And we're very committed to making sure that we do a killer job. And so the question is, well, how do we kind of do a killer job, right? And this is a lot of this is more on the post closing. You know, a lot of people sell you a home, and Kathy mentioned that forever, you buy a home or you sell a home and you never hear from the agent. We're the exact opposite. You hear from us quite often because we understand that our goal is not to help you once, it's to help you really for a lifetime, right? If we make sure that we take care of our people, that they end up taking care of. And that's really the philosophy that we kind of approach our business. So when we're helping you, that's the mindset. It's not like we'll get you in a home and we'll never hear from you again. It's we better get you in a good home because you know when we call you, you're going to yell at us, right? So we want to make sure we take care of you and know that the relationship is an ongoing one, not a transactional one. So we do this through many things throughout the year. This is our Valentine's Day where we do what are called Popeyes, where we physically drop stuff off to our past clients' homes. This is Valentine's Day 2018. We did these shovels and says we dig you, put some candy in it, obviously pre-COVID, and bagged them up and dropped them off. Last year we did some seeds for flowers, and this year we did bags of tea where again we physically dropped these off. Last year we did our big Easter egg hunt. We had about 50, 60 kids. We had barbecue, food, drinks. We hit about 300 eggs. We had the Easter bunny there. And this is all these things that I'm mentioning are free. This is not a, pay for admission or anything like that. So obviously with COVID, we couldn't do an Easter egg hunt. So rather than doing that, we reached out to our clients and said, do you want to participate in a virtual Easter egg hunt? We dropped off plastic eggs, and parents are able to hide them and fill them. And we had this Zoom call, as you can kind of see here in the middle. And it was just like, there's no kids on here. It was like a shit show, right? Kids were screaming all at the same time. And it was awesome. Next, we do our Mother's Day thing. So in 2018, we did a wine glass with bath salt, a loofah, and a pixie stick, and dropped off. Last year we did, what are these plants? Succulents, and dropped them off to the mothers that we helped. This year during COVID, we said, well, what can we do? We dropped off these face masks, I think they're called. And if they're wrong, I'm sorry. Something to put on your mask that makes your skin better. And then also nail polish, since the nail shops were closed, and we dropped off, God, I think 140 of these. So logistically, imagine, us going all over. And this is where Kathy kicks in, all with gloves and all kind of done COVID approved. In the last 5-6 years, again, pre-COVID, we used to do a concert in the park. City of Whittier puts together 2 concerts in the park, one on Monday, one on Thursday. We participate in the one on Monday at Central Park. We'll bring the pizza, the Subway, the drinks, the chips, the bubbles, the Frisbees, the chairs. And we just ask, hey, come hang out with us. And it goes on for 7 weeks. You can come 1 week, 2 weeks, all weeks. Just make sure you bring mosquito repellent, because it's usually pretty bad. But again, this is all free. In October, we do our pumpkin painting party in a pumpkin patch in Whittier, where we get about 100 pumpkins. We bring, again, the food, the tables, all the paint, and you can make a mess at the pumpkin patch. You don't have to do it at your house. And again, all this is free. We initially were hoping that it could be a pumpkin carving party, but they said no to 40 kids or however many kids to have knives in a public setting. So we went to a painting, and it actually worked out a lot better. We do our photos with Santa in November. So Santa Claus comes to Whittier. We have a big crafts area for the kids, and we get your kind of holiday picture set in November, and it'll be ready for you for your postcards. And again, this is all free. It's a Saturday and Sunday event that we do. So, one day you can join us, or you join us for both. And then our biggest event is our holiday party. We've been doing it since 2015. Our holiday party last year had about 190 people. It was a plated dinner. We gave away, I want to say, 3 large TVs, like 60-inch plus TVs, about 100 other prizes. Santa Claus was there. We had a photo booth. And then one of the neatest things is for Santa to come out, the kids have to sing, here comes Santa Claus, or no, Santa Claus is coming to town. And once they do, then Santa Claus comes out, and then he gets bum rushed by 40, 50 kids, which is kind of the neatest thing. So with that said, this is kind of what we do for our clients, and our hope is to, again, maintain this relationship for really for life, and to check in with you and to make sure everything is going well, and if there's maybe anything we can help, we'd be glad to do so. So if this makes sense, and this is kind of the relationship you want, we're excited to kind of move forward and be part of this milestone for you and your family. So the next step would be, or if you say, well, what's the next steps, is obviously meet with a lender partner. You get the pre-approval all done and kind of get your numbers squared away. Some of you might have already have done that. And if you have, then great. And at that point, we'll schedule a one-on-one with our team to go through what it is you're looking for, how soon, what size of a home, and so forth, and get out there and actually start shopping. And that is it. So with that, I just want to say thank you for staying a little extra here. Most of you stayed on. So at this point, Kathy, any questions? We're going to get every question answered.
Yeah, we had a few come in. Let me see. If the seller gives credit for areas of concern, is that removed from the total asking price, or like where do you see that?
That's a really good question. So if we get a credit, let's say it's a $3,000 credit, right? It's not reduced in price. It is $3,000 less that you have to bring in. So if you needed to bring in 100,000, right, in that example that we had, instead of bringing in 100,000, the seller leaves 3,000 kind of on the table, so it offsets your number. So now you have to bring in 97,000, right? So it's not a reduction in price. It's actual $3,000 that will be left in your bank account in a sense at the time of closing.
If our future goal is to invest in real estate in the future, will we continue to have the same agent for future purchases?
I mean, it depends. I mean, this is a kind of a people business. And so, yeah, and in the past, maybe it didn't make sense for that specific agent or, you know, God forbid they left our team or whatever it is. You just kind of come to us and say, hey, I want maybe a different agent or whatever might be the case. But it's not this is absolute forever, right? I mean, things change, and if things change for whatever reason, we're definitely adapting. Very similar to this virtual workshop. I mean, in the past we used to have workshops in person, and we started virtual last year, and it's now the way of doing business. So we're very much like fluid and can adapt pretty well. So if changes need to be made or updates need to be made, then that's what'll happen.
Sorry, so regarding that credit part, there's a little bit more questions about that.
Sure.
Is it part of your down payment that's reduced, or?
Sure. So it would be, so the goal is how does this 3,000 kind of affect your money, right? So in that example, that the 100,000 you need to bring in, and we said 10,000 in closing costs, so that's 110, right? You put 5,000 in deposit, you're at 105 that you need to bring in. So rather than you coming in and bringing in 105, right? You now, with that $3,000 credit I'll give you, you need to bring in 102. So that 3,000 is left in your account. So it offsets your what you need to bring in by $3,000.
Gotcha. Do we have lenders that we recommend?
Yeah, so there's 3 that we work with, I would say, for at least 6 to 9 years. And really, you know, you say, well, why one of these lenders? Why not, you know, Cash Call or all these other online lenders? Is just what's important about a relationship locally with the realtor. The same thing with the lender. If I know I get a pre-approval from someone that's local, that has a good reputation, I know they're going to get the job done. I'll tell you, if I get an approval from Cash Call or one of these online lenders, I kind of cringe, and I hope that's the offer the seller doesn't accept. And the reason why is, at the end of the day, I want to know that the other person is kind of on the same page to get the job done. And I want to be able to pick up the phone and call, you know, that loan officer. A lot of times when you're using these kind of companies, you're a 1-800 number that you call, and no one wants to talk to you, and it's just so frustrating. You want to use someone that's local to the market that you're interested in buying. And if you don't, you can definitely use anyone you want. We're not saying that, but you know, what we've experienced is when things go well, everyone is happy and okay. But when things go bad, and things will always go bad, right? Or surprises will come up, or something will come up. It's how that person handles it is the most important thing, especially when you're in a time crunch and time is of the essence. So the people that we've worked with in the past, you know, they'll pick up the phone and they'll say, hey, we have a problem. This is how it's going to get solved, and this is how we're going to get it done. Where the other side, where it's just, again, a 1-800 number, it's not a priority to them. They won't pick up the call, and it happens. I mean, I can't tell you how many times and how frustrating it is. You know, there was one where the seller was moving out of state and we couldn't get a hold of anyone, and the seller was looking at us and saying, well, you know, do we cancel? Do we not cancel? We have our truck kind of being packed next week, and it becomes really stressful. And same with you, if you put your 30-day notice in and you're not getting a response from the lender because they just kind of went dark on us, then obviously it's not a good place to be in. And you won't know that until you're really in the trenches. And so that's why I think using someone local is an important thing.
There was a question about the example that you gave about homes that are on hold and what that means.
So on hold home, they could be put on hold for many different reasons. If they're making certain upgrades, if maybe the family has family in from out of town, in the past that was a common one. Maybe if they're making some sort of improvements or updates, Maybe if they're just out of town, right? They went on vacation and don't want anyone to come to see the house. So there's many reasons why a home could be placed on hold. It's just saying that during this week or during these days or during this month that we're not allowing anyone to show the home. And so our goal is to call and say, well, why not? You know, if they say, well, we're out of town, or sometimes the sellers get overwhelmed and say, no more showings. We have enough activity, enough buyers that we're going to pick from what we have. So that could be a reason that the home is placed on hold as well.
Do you recommend meeting with the lender prior to meeting with one of the agents?
Absolutely, because you know when you meet with the agents, they need to know what it is you're shopping for, right? Might sound stupid, but it's like going to the store without your wallet, right? Because if you don't know how much purchasing power you have, if you're buying, you know, go back to the toilet paper, you buy 3 toilet papers or, you know, a box of toilet paper, right? Without knowing that, then it's like, well, how do you go shopping? So the understanding what it is you qualify for and making sure the payments and the finances is right, then it enables you to shop more efficiently and smarter, really.
Some people are asking for lender contact info. I can send that after the workshop.
Yeah.
There was a question about your opinion on what are your thoughts on short sales, and can you explain what that entails?
Sure. So short sale. So what is a short sale is when the sellers are asking the bank to take less than what they originally borrowed. So an example is I bought a house some time ago. I paid $500,000 for it. I got, let's say, an FHA loan, and my loan balance is close to $500,000. Well, values have dropped, and that loan is more than the house is worth. So the loan is maybe still $500,000. The house is worth $400,000. So the seller is saying, bank, we want to sell, but we can't pay you all the $500,000. Will you take a lesser amount? Will you take a shorter amount than what we owe you? In this case, $400,000, right? And so then the question is, well, those sound like a great deal. It sounds like you're going to get a better term. Well, think about what has happened in the market the last 10 years. Prices have continued to go up. So as a seller, you don't have to sell short, because if you bought 5 years ago, you probably have equity in the house. And so you could do a short sale, get your credit impacted, and walk away with nothing, or you just put the house on the market and you have enough equity where you're going to make money. So short sales just don't exist, or very, like, at least locally in the Southeast LA County, I would say out of every 500 homes there maybe is one, right? And just because, again, the market has appreciated so much, there's no reason to sell short, right? If everyone has, their values have gone up, so they would just put the house on the market. Even though they're selling it as is and don't want to do anything, it'll still sell for top dollar, even in today's, especially in today's market.
I do have a financing question in regards to employment. I have someone that is on call for like job assignments. So how does that determine like how you qualify?
Whew, that's a very technical question. So let's see if I can have a good answer. So if you're on call, right, it depends on if you're a W-2 or not. So if some businesses or some professions are on call and they have a on-call rate, right? So let's say usually in IT or medical or stuff like that, where you have your normal hours, and then for this weekend, you're going to be the person that they call just in case anything happens. So as long as it's a consistent thing, then they could use that income to help you qualify for. Now, if you're on call where, you know, I work with a lot of contractors or kind of handyman, and if you kind of have work when they call you, then that's a little bit different. Because so if you're employed by someone, or if you are consistently on call and you can verify that through pay stubs and another kind of formal documentation, then you should be a problem. But if you're on call and you get paid cash when you get called, then that becomes a problem.
So sorry, additional, the career is a substitute teacher.
Oh, as long as it's consistent, yeah, you know, I don't, that's probably a question that I don't say stumps me, but I don't know what the substitute world looks like in the middle of COVID. So the answer is, as long as it's a consistent on-call type job, like a substitute, then you're fine. But if it's every so often and the substitute world kind of is going to disappear because, you know, that I don't know because of that profession, but generally speaking, if you're consistently on call and you're consistently getting, you know, you're working, then it should be fine. They'll typically take an average of maybe a year or 2 years worth of income, and as long as that average is consistent, then you'll be fine.
Piggybacking on that, there's a question that came up. What about if you're switching jobs and you're waiting for a new contract? I know with school districts, there's usually like a gap during the summer.
Yeah. So as long as you have a pay stub under your belt, then you're fine. So we've had an example for the buyer Francisco had helped. He was sheriff and he went to LAPD, right? And it was in the middle of the escrow period. Well, the lender says you can still get a loan. We just need to make sure that this person has started his new job. So we had to wait until he received his first pay stub to confirm that he is obviously employed by the new department. So in that case, there could be a transition where you don't have a job, and ideally it should be 30, maybe 45 days, and then you won't be able to kind of get the loan per se until you have received that new pay stub that you are employed.
Can you use a retirement fund such as a Roth IRA, 401k to help with total costs, for example, like down payment, escrow, closing costs?
I don't know on a Roth if you can. On 401k, and this is where I would kind of defer to my wife if you take her class or ask her. Generally speaking, if you take a loan and you're paying yourself back, then you're not paying taxes or penalties on it because you're not withdrawing the money, right? That's something that's really important. But you now have a new monthly payment that the lender has to look at to make sure you qualify. Typically speaking, from your 401k, 403b, you can use it for the purchase of a home, and they will allow you, generally speaking, again, 50% of whatever your balance is. So if you have 50,000 in there, I would say a good rule of thumb is $25,000, 50% of that could be used for your purchase. They'll typically ask for a copy of the purchase agreement and maybe the escrow instructions, a few documents to show that you are buying, right? And I would say the processing time is, 7 days. There's one that, again, this is where you want to talk to, again, someone like my wife. There was one instance where if a box was checked, then it would have been 7 days. And if it wasn't checked because my wife kind of came in at the end, that there's a cool off period where they want you to think about, are you sure you want to take this money on it? You have to wait 30 days for them to release this money. And it was very problematic and stressful for all sides because we extended the escrow by 30 days from when they did that, and it wasn't good. So you want to make sure you take it out correctly, how soon you can get the money, and every 401k and program is going to be a little bit different on how soon and how they allow money to be released from their funds.
Yeah, I think biggest thing with that, Remo, that Eva's mentioned before is looking at your exact account to see what the terms are and like what it looks like for you.
Yeah.
Let's see. I think that's it. If anyone feels that I missed something, feel free to type in the chat again. But
I think there was one question, how do I see the market in the next 6 months to a year? I still think that the market is growing. There's going to be less sales, but prices are not going to drop. I think there's way too much supply. Interest rates are way too low. Interest rates, just as a sense of where are they at, you could get a 30-year mortgage right now with FHA close to like 2.5%. Never in the history of FHA financing has it been that low. And so, why is that important? Is because money is cheap. And so when money is cheap, more people want that cheap money to buy a house or to, obviously to live, especially when the alternative is renting, right? Do you pay $2,500? I'll tell you, I have a rental in East LA and it's part of a duplex and it's $2,700 for a 4-bedroom. And so that family at one point is probably going to say, do I continue to pay $2,700 or do I, decide to buy? And what does it look like? And that same $2,700, with a decent down payment might be a $500, $525, $550 purchase price. So do you, again, fix your most expensive thing on your budget, which is housing, and allow that to kind of be the same, or do you just kind of keep renting? And one thing I could kind of add, probably one of the most important things, and is owning versus renting is generational. And I say that respectfully, is if you want to empower kind of your offspring and your family, when you own, that becomes a new standard for the family. And I think that's really, really important part of owning real estate. If you want to set the family up for the future for a better situation, and we kind of mentioned it in our why, is, you know, for example, our daughter is going to see that we're homeowners, and that's going to be the standard to us. When our parents migrated here from Egypt when we were younger kids, they had bought early. And so for us, owning a home is kind of the next thing you do. And all my brothers own homes, right? And versus, you know, if you see renting as kind of the standard, then you have to break that at one point. And so I think of it as, obviously the numbers all have to make sense, but you want to just kind of put yourself in a better situation, you know, long term, and just, again, for your, especially with kids and so forth, you want to make that a standard. So I think that's an important thing, and maybe we just kind of end there. So if there's any other questions, I'll hang out for a few more minutes. I'd love to answer any questions. If not, the next step will be our team will reach out over the next, you know, day or two, and just kind of see what, if you have any outstanding questions, connect you with a lender partner, and then schedule maybe something more of a one-on-one to kind of get an idea of what it is that you're looking for. So with that, I want to say thank you for your time. I know we went extremely over than usual. Hope this was, you know, not entertaining, but entertaining as well, but value of your time, and thank you. And so I'll go through the questions. So if you guys log off, I'm not going to get mad or anything. So Kathy, any other questions that come up?
Yeah, there's one that came up. What's the average down payment percentage in this market?
So the minimum is the FHA, which is 3.5% down. So 3.5% of 500,000 is 17.5, plus, again, your closing costs, which is the cost of financing. The financing, I would say it's 2%. So in that example, you know, it's $25,000 to $30,000 for a $500,000 house. Now, again, there's other ways of getting the closing costs kind of paid for. There's what's called a lender credit. So, and this might kind of help with those that are comfortable with the monthly payment, but maybe the cash flow or the cash on hand isn't as accessible. A lender credit is granted in a sense that you take on a little bit of a higher of an interest rate. Long term, the bank makes up that money, so they give you a credit to offset your cash in order to close. So an actual example, let's say market rate is 3%, right? If you go to bank, 3%, you pay what's called a point, right? A point would be 1% of the amount. Let's say it's $500,000 you're purchasing. That 1 point is $5,000 in cost, right? That's at 3%. Now you hear this term that people buy down the rate. So that means you take you buy down the rate to 2.75, but it's going to cost you, let's say, a point. So instead of paying the $5,000, you pay $10,000, but you get a better rate. The same thing can happen the opposite way, where you say, you know what, can I get a lender credit? So instead of getting the 3%, they'll give you 3.25%, but that generates money in the short term that you can use to offset your closing costs. And again, some people, it might make sense to say, you know what, I'm comfortable with the additional, you know, $40, $50 increase, but that saves me $4,000. I don't have to kind of come out of pocket. So these are the types of things that when you meet with the lender, they'll be able to tell you, especially if cash is obviously a little tight. But to go back to that question, generally speaking, 3.5% is what's down. There's some down payment assistance programs that are out there that allow for less, but we talked about kind of some of the restrictions that might come with those.
We did get some feedback that it was very entertaining, Remo. So maybe.
Thank you. That's what happens when you drink like 4 cups of coffee in the morning. And a shout out to Alina from our team for giving me this coffee drink thingamajigger is. All right. Well, with that, I want to say thank you again, guys. If there's no other questions, just log off. If not, we can be here and I can entertain you for the next hour. So thank you guys again for